Hello viewers, welcome back to my channel. Today I am going to share you something about acid test ratio. So what is the acid test ratio in financial ratio? The acid test ratio, commonly known as the quick ratio, uses a firm's balance sheet data as an indicator of whether it has sufficient short-term assets to cover its short-term liabilities. Understanding the acid test ratio. In certain situations, analysts prefer to use the acid test ratio rather than the current ratio, also known as the working capital ratio, because the acid test method ignores assets such as inventory, which may be difficult to quickly liquidate. The acid test ratio is thus a more conservative metric. Companies with an acid test ratio of less than 1 do not have enough liquid assets to pay their current liabilities and should be treated with caution. If the acid test ratio is much more lower than the current ratio, it means that companies' current assets are highly dependent on inventory. This is not a bad sign in all cases. However, as some business models are inherently dependent on inventory, retail stores, for example, may have very low acid test ratios without necessarily being in danger. The acceptable range for an acid test ratio will vary among different industries, and you will find the comparisons are most meaningful when analyzing peer companies in the same industry as each other. For more industries, the acid test ratio should exceed 1. On the other hand, a very high ratio is not always good. It could indicate the cash has accumulated and is ideal, rather than being reinvested, returned to shareholders, or otherwise put to productive use. Some tech companies generate massive cash flows and accordingly have acid test ratios as high as 7 or 8. While this is certainly better than the alternative, these companies have drawn criticism from activist investors who would prefer the shareholders receive a portion of the profits. Thank you.